What's going on? Welcome to my channel. I'm the covered call guy, and on this channel my goal is to create 120,000 in annual passive income using only covered call ETFs. Well, actually, that's a lie. Not only covered call ETFs. I will eventually be switching. Well, not switching, not selling in a way. I will be having my core as my covered call ETFs, but dividend growth and closed-end funds, BDCs, single stocks, yada yada yada. Right now, my projected annual dividend slash options income is about $76,000 a year, 6.3K a month, 1.4K a week, and about $200 per day. Legal disclaimer before I start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just some random idiot you found on YouTube, and I can be completely wrong. All right, I'm only YouTube qualified or YouTube certified. All right, today's video is more of just not really an ETF or stock breakdown, but more of a response to a lot of the comments that are just kind of talking about as if like I didn't do my research on covered call ETFs. For the most part, I am going to agree on some of the points, but I'm also going to refute on some of the points. So I'll talk about it, right? So a lot of this is like, you call us the yield dealer, as in, oh my god, the yield is juiced up, this is why we're doing it, this is why we're buying it, right? You're saying, oh my, it's asset under management engineering and the art of losing money efficiently. This is what you guys are doing. You guys are idiots, so your dividend is just a refund. The payout is just a refund, and I want to address these points because I feel like a lot of these are talking points that are just regurgitated and kind of like the echo chamber that kind of goes on with one person says it. They never like cover call ETFs. They don't like income investing. They don't like income investors, right? They're the pure growth, and it's slow and steady. 1%ers, 2%ers, 3%ers, 4%ers max. Those are the type of people that are typically the ones to kind of leave comments like that. But I'm gonna address it, right? I welcome everybody. There's no right, there's no wrong. It's good to have different opinions. And in one of the comments, I go, they use options, right? Yes, I know. The common critique is here, before I talk about yield or NAV decay, I have to address what everyone yells at me in the comment section, right? Don't you know they just use options? Don't you know about rock? Yes, I do. That is the entire point, right? The real problem is I believe modern income ETF market isn't failing because you lack info. It's failing because surface level understanding is mistaken for due diligence, right? Options and rock have become internet jump scares invoked reflectively, right? It's kind of like that whole echo chamber that one person says it and it just like bottoms out everybody else, right? But really actually analyzed. Of course, you can say certain funds does it worse than others and certain funds does it better than others. That is another talking point. I'm going to my rebuttal here. All right, so the central thesis really is I'm going to talk about the big split, right? Theater is math. I argue that derivative income ETF universe has split cleanly into two irreconcilable design philosophies, right? The loudest funds aren't misunderstood. They are correctly priced. The yield dealer, right? The optics trap here. For those who pick this, their goal is that these funds are engineers to look good in screeners and screenshots. Their primary goal is assets under management acquisition, not capital preservation. What do I mean by that, right? Their traits. You see triple digit yields, daily income narratives, and distribution fully untethered from economic returns. The mechanism, they use derivatives to manufacture cash flow that exceeds the asset's growth rate. This is mathematically guarantees capital consumption. If you have those talking points in the comment section, this is the part I do agree, right? I mean, I agree that if you're just chasing the yield, you're just chasing at the numbers, of course that's going to end up bad. That is going to absolutely destroy you. I have no rebuttal against that because I am in complete agreement with you guys there. All right, process driven, right? I'm talking about the boring winners here. Okay, I'm talking about the other side. I personally, I see funds like Neos. I talk about Goldman Sachs a lot, right? They share three un glamorous traits. One, I always talk about this. If you're new, I always talk about this. For those who's been around, you know I talk about this a lot. First is the moderate yields, right? Typically around the 8 to 12 percenters, right? Second is the tax efficiency. It's a feature, not a bug, right? The structural advantage built into this. They purposely at times lose um on paper, if you were to read their statements, it would look like they're losing money. They do this on purpose, right? It's kind of like what we do for a wash sale. They do this on purpose for that, accounting feature, right? And then three is the risk controls, right? The explicit upside and downside management, right? They don't promise that weekly dopamine hit. They don't promise that ultra high yield, right? But what they do promise, and what they have been actually showing, with the data, historical points, right? They've been following their own perspectives, their own thesis, their own strategy, right? They promise to exist, to still exist after the next drawdown, and we've seen it. We've seen it. They've been showing us that, hey, we can recover from a sharp V-shape crash. We can sustain. They are extremely resilient in a downward bear market, right? Or in a choppy market. They have shown us that they can actually be somewhat resistant to a bad market that can turn the other way when it's no longer just shooting upwards. Right, the physics of finance, right? It's just a quote here that I like, that I've seen. The derivative income space is not risky or safe by category. It's bifurcated by intent, right? Yield data optimized for visibility, process fund optimized for survivability. So once you understand these two, once you can break down these two and kind of see which fund does what ETF does what stock does what, you will see the huge difference between there's the one side of the ultra high yielders, and there's the other side of, hey, look, 8 to 20% is fine, 20% is kind of pushing it. 8 to 15, I would say that's very, very doable. At 8%, you're doing like what, 0.8% a month, right? 12%, you're doing 1% a month. 15%, you're doing like 1.1, 1.01, give or take. Math is not 100% there. I'm just giving estimates. So that's very sustainable. Are you telling me right now, leave in the comments, you're telling me you cannot get 1% per month? You can't make 1% of your money per month. Are you telling me it's that difficult in this environment, in this market, in this modern stock market? It's that hard? That the only way to actually for it to be viable is to hit that 2 to 4% yielder? If it is, don't even invest in a stock market. There's absolutely no point. If you're getting an annual 4% return, we are all gonna get crushed, destroyed by this inflation. Just look at the prices from 2 years ago. Look at the prices from 3 years ago, 4 years ago, 5 years ago, before COVID. Everything has nearly tripled. That's like the baseline now, tripled. We would get absolutely destroyed in this market, especially how volatile it is. This is like the perfect environment for this type of investing, and I think it's only going to get more volatile. I believe the Fed is already easing into what they call quantitative easing. What it means, they're going to start to print them back up, and they're going to slowly start injecting money. What does that do for us? Is one, is going to pump the market. It's going to make everything more. It's going to make assets a lot more higher price. It's going to make everything else more expensive, and there's going to be a lot more liquidity. Now, again, that's half and half, right? Liquidity doesn't always mean good. It just means when you run a printer, of course, it's going to be more liquid, but everything else is more expensive, so you might not have a lot running through the system. But before I talk too much about something different, this is what I mean. You just understand the two different aspect of things here. All right, let's talk about the OG cover calls. All right, so before it was a personality trait, the original cover call strategy was born by design. You own the stock, you sold the call, you accepted less upside for income, no leverage, no heroes. The ETF wrapper and basically industrialized this. While, yes, some were flawed, it did retain physical equity ownership, anchoring NAV to something tangible. And I want you to understand this. For those who leave the comments about cover call ETFs, income investing, that anchor is exactly what modern yield data funds intentionally remove. Okay? There's two different sides of yield cover call investing, high yield investing, right? Depending on what your metric of high yield is. Some people say anything above 7% is considered high yield. To some degree, I do agree. And then of course, with if you're talking specifics, right, I would say, especially with these cover call ETFs and these ultra high yields, anything above 20-30% is really now in that real high yield territory. That's what I would consider. And anything above 50% is the ultra high yield. So I kind of split into that group here. Right, synthetics exposure, right? Simple way is weaponized math. Use responsibility. Synthetic exposure is a long call plus short put definition right here, created for efficiency. It allows for treasury collateral yield, options income, overlay, and risk managed exposure. And if you use it irresponsibly, right, when used for assets under management engineering, it allows yield target detached from reality and permanent NAV ratcheting lower. It becomes a weapon when success is measured by flows, not outcomes. Again, I don't put names out there. I'm just letting you know. Understand the different type of issuer you buy. Understand the different stock you buy. Understand the different ETF you buy, right? On this channel, for those who leave the comments talking about cover calls and how it would never survive, you're talking about a very specific type of fund here, right? You're talking about a very different group here. You're talking about the ultra high yielders. For the most part, you are. Right? You're not really talking about the high yield anywhere from like 15 to 30%. Those are still survivable and sustainable. Again, it just depends on market conditions and what they hold as the underlying. And then if you're talking about the 7 to 12, 15%, those are very doable. Again, I will defend those till the very end. I think the math behind it is very, very doable. You're telling me you can't do 1% a month? I don't know. That's just hard for me. In this type of environment, in this modern economy, in this modern stock market, I think 1% is doable. Right? Let's define the yield data here, right? Formally, not emotionally. You know, what that means is just as a strategy that prioritizes headline distribution, yield over NAV stability to maximize short-term asset under management growth. They do this by saying, hey, we do weekly or daily options, right? The 0 date time expiration gamma, right? That's the way to entice investors and be like, yo, we pay weekly, yo, we do daily options, come buy us, right? Capped upside with full downside, right? They tell you that you're getting these juicy yields because they use that strategy, but the cap upside and no downside plus the weekly and daily. And then of course, chronic reverse splits, right? Rebranded as corporate actions. Now, if a fund needs to tell you income is income, it already failed. A lot of comments you should be directing to certain, ETFs and issuers and stocks, not specifically anyone that does the 7 to 15%ers. The 7 to 15%ers, I will defend to the grave. If you can't do 1% a month as a hedge fund, I don't know. Then it's a terrible goddamn hedge fund or a issuer or whatever they want to call it, active management company that does stocks, right? If Spy Eye can't do 1% a month, that team needs to be dissolved and needs to rehire somebody else to be doing this. But so far they've been doing it. They've been executing very, very well. Spy Eye does what, 12%? You're telling me they can't really realistically do 1% a month? Is it that hard? I don't know. Is it? You guys let me know. Is it that hard? What you guys are leaving comments on but not talking about is the YieldMax. This is the erosion machine. YieldMax funds are not misunderstood. I'm going to say it again. YieldMax funds are not misunderstood. They are correctly priced liquidation vehicles with excellent marketing. They have an extremely good PR firm. Okay, Selling calls on the most volatile stocks, right, Tesla, MSTR, while capping upside is not investing, is a systematic recovery avoidance, right? The ratchet effect is not a bug. It is their strategy. You can't hate on YieldMax. They're literally telling you we are juicing up the yields by all means necessary. And if that means destroying your capital, then that means destroying your capital. The reverse splits are not unlucky. They are inevitable. Inevitable. God, I hate that word. But anyways, yeah, it's literally, it can't be, you can't escape it. If you've done your proper research, your due diligence, you would know YieldMax is you can't hate on YieldMax if you've done your research. You really can't. They're telling you in their face, we're paying 100% yield because we're doing this. Now, if you still buy it and then you get mad, I mean, whose fault is that, right? Hey, it is what it is, right? And for those that leaves a comment about it, but don't mention it, I know you're talking about certain. Not all cover call ETFs are built the same. I just want to say that not all cover call ETFs are built the same. And then another one is Defiance, right? This is the skinnier box of. This is like the. I'm not gonna say it's still popular, but I guess this is like the distant cousin of YieldMax, right? Frequency bias as a model. Defiance didn't invent daily options. They invented daily reinforcement. What do I mean by that? Well, they're quite popular for weekly pay. Weekly pay doesn't change return. It changes behavior. It's also illogical, right? It depends on what you do with that weekly pay and how you execute. 0-day time expiration strategies turn investing into a skinnier box. What does it mean? Flat day, reward. Down day, ignore NAV. Repeat until capital is gone. A 30% distribution rate with a 1% SEC yield is not innovation. It is a disclosure quietly screaming. It's like, yo, I'm about to run out of money here. What are you going to do? I'm about to run next day. I'm about to run out of money. What are you going to do? So on and so forth. The quiet funds. This is what I talk about. This is what I'm talking about, right? Why boring wins. I talk about NEOS a lot. I'm going to use SPY as an example. It works because it's unfashionable, right? Uses index options, buys upside protections, and treats ROC as a tax tool. I talk about JP Morgan a lot, right? JEPQ. This is the heavyweight champion of process, institutional scale, physical holdings, and reasonable yields targets, right? It doesn't need a gimmick. It doesn't need a PR team. It doesn't need a sales team. It doesn't need advertisement. And then when I talk about Goldman a lot, which is one of my cores, right? I talk about GPIX. It works because it behaves like a Goldman, right? Dynamic overlay, physical equity ownership, and no need to cosplay as a fintech influencer. It does this by being an institutional. It's like that guy that walks and always dressed properly, suits, right? He knows what he's doing. He knows what he's talking about. That's the Goldman. You know, he has a reputation. He's not gonna burn his reputation by doing something dumb. All right, Roundhill. I talk about this one a lot. I'm going to put Roundhill in the gray zone here, right? It does have a better structure. I'm going to say Roundhill's QDTE/XDTE products are structurally superior to Defiance because, okay, they use index options and have a better tax treatment. For the most part, I'm going to put them above Defiance. All right, and the income costume, I'm going to say, however, weekly pay plus 0-day time expiration still introduce gamma risk and some income illusion. So just know what you're buying and how they're executing and performing and what your plan is when you're buying this, right? They aren't scams, but they are a volatility trader wearing an income costume. Know what you own. That's it. Know what you own. A lot of people want to, talk smack about it, but as long as you know what you own, you know what the plan is behind it, you'll do fine. You'll be right. And then, of course, ROC, right? Tax lie or lie detector. I get this one a lot in the comments too, right? I'm just going to say ROC is a diagnostic, right? Return on capital is not inherently good or bad. It just tells you what is happening. For YieldMax, ROC is liquidation, and NEOS, ROC is the deferral. This one, look, you're gonna have to do your own research on this because I can only explain it and talk about it so many times, right? Confusing the two is how you end up paying ordinary income tax on your own money while defending the fund online and just embarrassing yourself. I mean, if you're gonna say that all rock is bad or all rock is good or all rock is just the same, look, I've said it many times, right? Rock is an accounting feature. Used properly, and you win. Use our responsibility, and you lose. It's that simple. For you, Max, obviously you're losing here for the most part. If you invested quite heavily, and Neos, the math doesn't lie, the numbers don't lie, total return don't lie. You're up big. You're winning. Why do I defend bad funds? One is not because they work, right? People like to defend YieldMax because they are paid frequently and haven't sold yet, right? They're kind of in denial. And for me, I defend bad funds because everyone has a different purpose that they're aiming for. Perhaps YieldMax would help you achieve it. I don't know, but I'm not gonna hate on it. You do you. Ego protection. Admitting error hurts more than doing the math. Hey, look, I can admit I'm wrong, but I've never really seen the YieldMax investors that are deep into it really give out that, say, oh, yeah, I messed up. Haven't really seen it yet. And then third, the reinvestment lie, right? Reinvesting dividends into a decaying asset is not discipline. It is just denial with spreadsheets. All you're looking at your spreadsheets and you're saying, oh, man, the numbers are going to get better. The numbers are going to get better. It's going to improve. I swear, next month is going to be better. Next year is going to be better. And then by the time you're looking at it, it's like you hit zero. Oh, I'm gonna make my house money back. Yeah, you're probably not going to. Hey, I do hope it, but again, I defend it just because everybody does have a different purpose on how they want to invest. Right, the law of extraction. This is simple. You can't extract 50% yield from a 10% asset without consuming the asset. If you don't understand that, then it's going to be a painful lesson, right? Funds that respect this law compounds quietly. Funds that ignore it trend loudly until they don't. You've guys seen it. If you're new, you will start seeing it. But if you've been around for at least half a year, you've seen this, right? Remember, it was like a cult with these yield maxers, right? It was like a literal cult. And at some point, people were actually hating on Neos. I don't know, for those who's been doing this for at least a year, you've seen it. People were actually hating on Neos because why would you do a 12%? This is SPY is outdated. You can get 50, 60, 70, 80%, 90%. This is sustainable. And then people who are invested in Neos, I've seen this happen. I've seen it online. I've seen it. Neos, people in investing in Neos were like, no way 50% is sustainable. And it might do well for 3 to 6 months, maybe even pushing like 8-9 months, but it will eventually crash. And the market, look how the market turned, right? Hey, only the loud gets all the attention, and they were loud. But Neos in the background, just working quietly, head down, not saying anything. Just, you want to come in and try us out, come and try us out. If not, move on to the next. I like that. Right, there's just the FAQ, right? For those who only read the tickers, right? Cover calls always I get this comment. Cover calls always underperform. Yes, and minivans are slower than Ferraris. They are designed to beat the S&P 500 in melt-ups. I say this a lot. I say it in almost all of my videos, right? Complaining about underperformance in a bull market when you're investing in cover calls is like complaining insurance didn't outperform your house. It doesn't make sense. You're doing a trade-off here, right? Why is my cap upside? Why would you do that? Why would you do that to yourself? Well, because you aren't trying to retire off a single market regime. The question isn't why upside is capped. It is what you were paid to cap it. I could realistically, if I didn't want to live in the United States, I can realistically retire right now with my investment plus my additional, things that I have. I can all into the stock market, boost up my income to at least another 2-3K, pushing 10K a month, and I could be done. I think I could survive. I think what I have now is very sustainable. It's just what I'm willing to trade for my capped upside. I mean, You can wait 10 years for your growth, but I rather not. I rather wait every month and get my growth every month. And I'll probably make another video on that, talking about that. And then fact part 2, the do-it-yourself guy. I get this a lot too, right? Just buy the stock and sell calls yourself. You can also fly your own plane. Most people saying this has never actually rolled a call during volatility spike or modeled after tax outcomes. Oh, dividends is better than options income. Well, this isn't just an argument. It's straight up preference, right? Dividends get cut, options are contractual, neither is holy. I say do both. I have no problem doing both. As you know in the beginning, I say cover call ETFs until I hit 10K a month, and then I'm gonna start spilling into dividends and the growth. I like both, but for now, I just rather not wait for the growth. I rather not wait 10, 15, 20 years. I rather wait and get it every month, build it up. In the case that I can't get the growth, and like say something happens to me medically, or I get fired, and I actually have to start spending this income to start living, I can actually start living my life. All right, and of course the tax blind spot and volatility, right? Most retail analysis end at the distribution rate. It never reaches marginal breakage or section 1256. Index options quietly outperform flashy yields taxed at 30%, 37%, right? Volatility is not a piggy bank. Funds assuming permanent volatility eventually face premium compressions and NAV bleed. Volatility is a resource, not an entitlement. I say this a lot in almost all my videos, right? Treat it as such. Treat it as a resource. It's the same way when I tell you guys to treat that distribution as a paycheck. Put 10 or 15% aside for the tax man. And if you don't need it for tax man, if that year you got a lot of rock received, reinvest it. I always encourage everybody to reinvest it, right? Hey, that's what I'm doing. I think it's a great strategy. Right? My final verdict, the reverse split fallacy, repeated split signal structural decay, not bad luck. They are post-mortem findings, right? Why investors choose quiet funds, why advisors choose quiet funds, and people like me, I'm not an advisor though, I'm just saying they would rather choose quiet funds. I have that same philosophy. It's because they care about retention, tax efficiency, and most important, survivability, not Reddit sentiment. I always say, I made a video on this, keep away from Reddit. There are a lot of knowledgeable people, but it also becomes an echo chamber, okay? You don't want to do that. When you are getting into income investing, you do not want to end up in an echo chamber. It will absolutely destroy your trading philosophy, investment. You're starting to build up your investment thesis, your own investment thesis. Understand where you're trying to be a year from now, 5 years from now, 10 years from now, 15, 20 years. And that's how you should invest, right? I'm trying to retire within the next 3 years. Hopefully, if not within the next 3 years, before I'm 40 years old. I'm in my early 30s. I'm trying to step away from, retiring at the typical 59 and a half or 62 or 65. So my investment strategy has to reflect that. Right? So that's why I say the loudest fund promise income, the quiet funds deliver outcomes. One survives the market, the other survive the comment section. And guess which one you guys are. I'm kidding. Right? So this is just a cheat sheet, right? Don't get wrecked, right? So here you can pause it, and I'm just letting you know that, the gimmick is YieldMax Defiance versus trust the process, right? Niels and Goldman, right? They so far have been very sustainable in income, capital respect, right? They've been growing it, and very tax efficient. The market always tells the truth eventually, right? The only question is whether you listened before the reverse split. That's on you. That's on nobody else but you. Right? Don't be exit liquidity, right? Smash if you hate losing money. Subscribe if you want to keep yours. So I better see some likes, and I better see some subscribe, right? So subscribe for more truth bombs, because this channel is all about unfiltered truth. I say what I say. I'm going to say it how it is, all right? Drop a comment. Which quiet fund are you secretly holding? Don't gatekeep. I'm trying to build my holdings, so drop them. Let me know. I want to know. I want to know. I want to know. Thanks for watching, guys. Catch you guys on next. Stay tuned.